Thanks for downloading this episode of the Resilient Advisor podcast. My name is Jay Coulter. On this episode, we are going to discuss the future of the financial advisor with the CEO of eMoney Advisors, Ed O'Brien. Before becoming the CEO of eMoney Advisors in March of 2016, Ed worked for Fidelity Investments, where he served as the head of platform technology. And this gives Ed a unique and wide lens into the industry, so I'm curious of his thoughts on the future of the business. Ed, thanks for coming on.
Thanks, Jay. Great to be here.
All right, let's get right to it. And let's start with some questions and your thoughts around the advisor-client relationship, since that seems to be going through a fairly dramatic transformation. How do you feel artificial intelligence is going to play into the advisor-client relationship going forward?
Yeah, I mean, if you start with the question that you asked there, I think technology is going to play a big role. It already does today, but continue to grow as the relationship between the advisor and the client. And that's already happening, and I think artificial intelligence is just the next step on that journey. And so some of the things that we are very focused on, again, making the technology between the advisor and client very connected, meaning that the advisor is aware of what the client sees, being able to push notifications out to the clients, reminding them to check in on their financial plan, maybe if they have tasks that they need to complete, reminding the client that they need to do that. Similarly, the client gets to communicate back with the advisor through our technology. So I think the future here is technology that's very easy to use. It really creates collaboration between the advisor and their client, and it's available 24/7. I think that's one of the things advisors will have to manage over time is the expectation that technology makes it always available. So the advisors will need to lean on their technology to help them serve their client base at times that they're not always available to pick up the phone or answer directly.
So the advisors that embrace AI, they're going to be able to be more proactive with their clients as it relates to the financial planning and managing the client relationship, but also give the appearance of being on call 24/7.
I believe so. And again, as consumers of technology, we all expect to be able to do things, at our own pace and when it's convenient for us. I don't see how financial advice completely escapes that expectation. So yes, I believe that. So I guess if you look at how an advisor thinks about AI, machine learning, those are the techniques they should be thinking about and enabling to do some of the lesser value work. But at the end of the day, the core role of an advisor today is to make sure that they're helping the client understand their financial need, make them stay on track with their plan. So it's more emotional than it is transactional. And so they'll have to create bandwidth by, sort of getting some of the lesser value work through AI and machine learning so that they keep the capacity to spend on that higher value work with the client.
Wouldn't you say that's why you really see the field of behavioral science and behavioral finance starting to have a real impact in our industry?
Absolutely, Jay. And we even start to see things like where the industry has grown up relying on, pretty scientific calculations of Monte Carlo, and how do you start to integrate behavioral attributes into that? Because if you find out in an iteration of a Monte Carlo that your likelihood of success is low, chances are the advisor is going to help that client change behaviors to get them back on track. So we're even thinking about things like behavioral Monte Carlo, using AI, machine learning to help project how someone may even change their behaviors to get back on track.
Well, that's a great segue into the next question as it relates to behavioral modification. So this question comes from Ty Pipkin of Canopy Asset Management in St. Simons, Georgia, and he wants to know what trends you see among the planning-focused advisors as it relates to preparing for volatility in the next bear market.
you do more financial planning. This is one of the things that comes right. No, this is one of the things that comes up very frequently, and by the virtue of creating a comprehensive financial plan with the client, the advisor can tell their client to relax because guess what? I've already done that work of preparing for the unexpected and helping you prepare for the ups and downs of the market. All I need you to do is relax and stick with the plan. And that becomes the tough work when, the market starts to decline unexpectedly, or, life events also are a factor in that as well. The true value of the advisor is establishing that plan and keeping the client on board through the ups and downs.
So along those same lines, another advisor reached out with a question. This is Parth Vikal of the Piedmont Group of Mass Mutual in Atlanta, and he wants to know what you would say to those folks who may still feel as though a purely investment advisory relationship is sufficient for their family. And that's a great question in context of what we just spoke about. How do you move that needle?
Well, I think this is also related to the question around where's the value of the advisor. And let's face it, we're seeing more and more choices at lower cost with respect to being able to put my portfolio into, models or, managed account. And so I think advisors need to spend more of their time focusing on the things that help a client, with their financial plan, their overall financial health and well-being. And those things are more emotional, right? It's sometimes having the tough conversation about how do you think about treating in your estate plan your children differently because they're at different phases in their life and different points of responsibility. So those are things that are going to be a lot harder to do, but add a lot more value than simply directing a client to a particular asset allocation.
So really, the advisors that are facing the resistance from families that don't want to plan, they owe it to those families to keep chipping away and getting them to change their behaviors to buy into it.
They do, and let's face it, a lot of times because when you establish a financial plan, there's outcomes from that plan that you may not want to see or implement. Spend less. Don't buy the boat. I mean, there are very sort of natural reasons that clients would resist, and that is absolutely the role of the advisor that establishes a plan and keeps clients focused on better outcomes for the long run.
So let's switch gears, Ed, and go through a mini thought exercise. So over the last 6 months, I have found myself in conversations with advisors at wirehouses and the independent space, concerned about what the future looks like for financial advisors. So if you had a crystal ball, what would you say the financial advisor of 2028, 10 years from now, what does their job look like?
Interesting. We're just finishing up some research, and we'll talk about this more at our upcoming Advisor Summit in a couple of weeks, which we've coined this term called the Flux-Gen Advisor. And it is trying to project out exactly that, Jay. What does the role of a financial advisor look like, a successful financial advisor look like in the next decade? And there's a couple things that came out of it. Really high level, they are forward thinking. So they are not just simply focused on maybe the way that they've worked with their clients in the past. They're forward thinking, even for the current generation of their clients, trying to help them anticipate rather than react. Advisors, so they're helping their clients embrace change, because that's something we're seeing that in just about every element of life, change is happening in much faster pace these days, whether it's technology, whether it's jobs. So advisor helping the client think about change is going to happen. The best thing we can do is put together a plan, and in that plan, we will help, anticipate change rather than be shocked by it. The other elements that we're seeing that are coming out of these advisors that we call the Flux-Gen Advisor, they love learning, and you can see a very big difference in that. And they sort of challenge the conventional thinking of how do you think about their role today. So that's high level. The good news, Jay, is when we see advisors that sort of embrace this Flux-Gen attitude, they are already seeing higher increases in the number of clients that they're managing and the growth in the assets of those clients. So I'm pretty optimistic that advisors that really embrace change, they are forward thinking, love learning, and commit to it are going to be perfectly fine and really sort of thrive in the future.
If you think about the car industry 50 years ago, the ones that were forward thinking, that they built cars for their customers and they continued to improve the technology, survived. It's the same thing. I look forward to reading that report. Is that public right now, the Flux-Gen Advisor?
It's not. It'll be coming out probably in mid-October.
Excellent. And while we're on the topic of your advisor summit, is that open to the public if folks wanted to register?
It is. I think the registration is actually closing shortly, today or tomorrow. So it is available on our website. It's eMoney Advisor Summit.
Excellent. We're recording this podcast at the end of September, so if you're interested, please head over to the website, and I will include links in the show notes. Let's shift gears to the actual eMoney platform, because I did receive some questions on it. The first, with all the advancements in financial technology, how do you view the integration of eMoney with portfolio systems such as Black Diamond and Orion today and in the future?
Yeah, I think, listen, for us, planning is a large component of the clients that use our platform. Generally, they're planning-led advisors, but it's not the only thing that they need to run their business and help produce the right results for their clients. So importantly, the platforms that you mentioned, Black Diamond, Orion, but there's lots of others in the domain of CRM and, managed account platforms that we, are always committed to doing integration with. And so as we think about our typical, portfolio of investments in technology year over year, a healthy portion of that is directed toward making sure that we not only maintain but continue to grow our open architecture into these other systems that advisors use.
So with that open architecture, there has to be a set of problems that arise that advisors could have concerns about. Do you have any thoughts around what advisors should and shouldn't be concerned about in the future as you continue to open up the architecture?
Well, you point out a really good issue, right? And that as the technology has evolved to make the integration between platforms much easier through APIs, importantly, at least from eMoney's perspective, it's not just about connecting APIs to another platform. It's making sure that we have the right service model, making sure that we have the right monitoring in place so that there are, focuses on the quality of the integration. We do lots of due diligence around things like how are the integrations implemented so that they're secure and that they're stable. So those are all things that we focus on a lot with the idea that the advisor shouldn't have to. So I'm hopeful that as advisors use our platform and they're integrating to other systems in our ecosystem, that they're not worried about those things. It's because we have.
Well, that's a great segue into our last question. And this one is from Eric Hollifield, who's a managing partner at Hamilton Investment Counsel in Atlanta, Georgia. And he asks that since some of these technology applications are getting so advanced and they overlap in a lot of ways, could there be some consolidation coming? And what would that look like for both the advisor and the client?
It's a great question, and I think we're already starting to see some consolidation, and maybe it's as I pointed out earlier, even in financial planning, sure, you can run a financial plan in eMoney, but in order to do a really good job, you want to have integration, you want to have a collaborative website so that advisors can share documents through vaults. So I think all of the fintechs serving advisors are doing their best to put together the right capability set to really, serve the advisor best they can. But I think that's okay, because over time, even if there's some overlap in capabilities of these platforms, advisors will get to pick and choose that if there's one that they like better, they can use it. A good example, Jay, would be, how many weather apps do you have on your phone? 3 at least. And it's not a bad thing, because I usually have one go-to and a couple that I might check if I have, maybe a little bit of hesitation on what I see on one. But I think that's an okay thing. For the advisor, I think what they'll just need to scrutinize is, do I feel like if I'm getting too much overlap, am I paying too much? And I think that's where, the advisor then will have to scrutinize how they're using the technology, which, quite frankly, I think that's, with all the technology that is available today, advisors should be doing that anyway, is, look at adoption, and are you paying for stuff that's not getting used, and ask yourself, why? Why pay for something that's not being used? And I think that's just going to play out more here as you start to see more overlap in capabilities.
Excellent. Ed, thanks so much for coming on the podcast. This was really insightful, and I look forward to seeing that Flux-Gen Advisor report once you guys launch it. I'll make sure that we promote it on our social media handles.
Thanks, Jay. Great talking with you.